What we're about to show you will make the 2008 housing crash look like a minor market hiccup. The numbers we've uncovered from 2025 and early 26 aren't just alarming, they reveal a mathematical impossibility that's been brewing right under everyone's nose. We're witnessing the most severe affordability crisis in American housing history, where the basic math of homeownership has completely broken down. But before we reveal the shocking data that proves why this housing crisis will be 100 times worse than 2008, you need to understand what's really happening beneath the surface of today's housing market. Let's start with the most devastating statistic that mainstream media is completely ignoring. According to Adam Data's latest Q4 2025 affordability report released just this month, homes were less affordable than their historical norms in 99% of U.S. counties. That's 586 out of 594 counties analyzed. Think about that. 99% of America is now mathematically unaffordable for typical households. But that's just the beginning. Here's something that should terrify every economist in America. Over the past 5 years, home prices have jumped 54%, while typical wages are up only 29%. That means home prices have grown nearly twice as fast as incomes. So every year that passes, the typical household is chasing a moving target it simply cannot catch. Americans now need to earn $86,374 annually just to qualify for a median-priced home of $365,185 under standard lending guidelines. But the average wage is only $77,038. This isn't just a record, it's a mathematical impossibility for the vast majority of American households. Now, let me explain why this situation is fundamentally different and far more dangerous than 2008. We're experiencing the perfect storm of three factors that have never converged in housing market history. First, we're seeing structurally unaffordable prices that have disconnected from economic reality. Even after some modest improvements in Q4 2025, homes remained less affordable than their historical averages in nearly every market across America. These aren't just high prices, they're prices built on a foundation of 3% mortgage money that no longer exists. Second, mortgage rates are stuck around 6% with no path back to cheap money. The average 30-year mortgage rate is currently 5.99% as of late January 2026, down from 7% plus peaks we saw in 2023 and early 2024, but catastrophically high when stacked on top of bubble-era home prices. Here's what makes this truly unprecedented. We have 2021 prices with 2026 rates and 2026 wages. It's as if someone built a house of cards on a foundation of cheap money, then pulled away the foundation while expecting the structure to stay standing. Third, and most crucially, we're seeing a fundamental buyer rejection of the market that dwarfs anything from 2008. Throughout 2025, Fannie Mae's National Housing Survey consistently showed that only about a quarter of Americans said it was a good time to buy, while roughly 3/4 said it was a bad time. Sentiment that has barely budged despite rate improvements. To put this in perspective, even during the depths of the 2008 crash, most Americans still thought it was a good time to buy. We've never seen this level of market rejection before. This isn't normal cyclical pessimism. This is a buyer strike. Let me show you how this feels to a real household with simple math that nobody else is talking about. Imagine a typical home that sold for $350,000 in 2019 with a mortgage rate at around 3.75%. The monthly principal and interest payment would have been approximately $1,620. Now, take essentially the same home in January 2026. That home now costs around $485,000, a 39% increase, and you're looking at a mortgage rate of 5.99%. Your monthly payment? Nearly $2,900. That's not a typo. We're talking about a 79% increase in monthly payments for the same roof over your head, while wages have grown less than 30% over the same period. The key point isn't the exact dollar amount, it's that wages have not kept pace. So the share of your paycheck going to housing is permanently higher. The system only works if people make money they don't actually earn. This is why affordability metrics show buyers needing to dedicate an unusually large portion of their income to ownership compared with historic norms. The math just doesn't work anymore. Real quick, if this market intel is helping you make better decisions, hit that notification bell, will ya? We drop new housing data every week, and the viewers who catch it first get the best opportunities. The bell ensures you see everything immediately, not days later when the market's already moved. We're now trapped in what we call the affordability death spiral, and here's exactly how it works. Step 1. Prices stay elevated because sellers are anchored to 2021 valuations, and many markets still have tight inventory. Step 2. Mortgage rates come down from their 7% peak but stall in the 6% range, which is still toxic when combined with inflated home prices. Step 3. Buyers hit an affordability wall. They simply can't or will not stretch further, so demand stays muted even as rates edge lower. Late 2025 coverage described this perfectly. Affordability showed only a faint improvement as buyers hit a wall. When rates dipped from the 7s into the 6s, buyers didn't rush back into the market like they did in previous cycles. They stayed on the sidelines. Step 4. Here's the trap that makes this spiral so vicious. Even if home prices dropped 10 or 15% in some markets, a monthly payment at 6% or 6.5% is often still higher than it was just a few years ago when rates were nearly 3%. Let me prove this mathematically. A $485,000 home today at 5.99% has a monthly payment of about $2,900. If that same home dropped 15% to $412,250, but rates stayed at 5.99%, your payment would be $2,465. Still 52% higher than that 2019 payment of $1,620. That's the death spiral. Modest price cuts don't fix the monthly payment problem because the rate environment has fundamentally changed. So, what about the Federal Reserve? Can they just cut rates and save the housing market again? Here's where things get really concerning. Current forecasts suggest mortgage rates will likely hover in the 6 to 7% band through much of 2026, with Fannie Mae projecting rates could average about 6.2% in early 2026 before potentially dipping below 6% by year-end, if economic conditions allow. We already saw through 2025 that even with rate relief from the 7% plus peaks, affordability remained strained and homes stayed less affordable than their historical averages in nearly all markets. That means the heavy lifting on affordability cannot come from rate cuts alone. The Fed is essentially trapped. Cut too aggressively and they risk reigniting inflation. Keep policy tight and they lock in an environment where housing remains unaffordable for millions of households. This is fundamentally different from 2008, where we could fix the problem by addressing bad lending practices and flooding the market with cheap money. Today, we're facing a basic affordability crisis that can't be solved with traditional policy tools. Even President Trump's recent directives for Fannie Mae and Freddie Mac to buy more mortgage-backed securities haven't moved the needle on underlying affordability. The bond market is essentially telling the Fed, we don't believe you can control inflation without keeping rates elevated. That's why we saw the unprecedented situation in 2025 where the Fed cut rates but mortgage rates barely budged. Let me show you how this crisis is already playing out in real time across America's largest housing markets because this isn't hitting all regions equally. In Florida, for instance, which many considered bulletproof due to migration patterns, we're seeing homes sit on the market significantly longer than during the pandemic boom, with price cuts becoming routine rather than exceptional. In Texas, which was supposed to be immune to housing crashes due to its business-friendly environment and population growth, inventory has surged compared to just a couple of years ago. A clear sign that buyers are stepping back even in so-called bulletproof markets. Even in premium coastal markets like parts of California and New York, we're seeing luxury properties sit on the market for unprecedented periods, often with multiple price cuts before selling. This pattern precisely mirrors what we saw in 06 and 07, where major housing corrections historically start at the high end and work their way down to the broader market. But here's the factor that virtually no one is talking about: the hidden demographic tsunami that's about to hit this already broken market. The largest cohort of baby boomers is approaching the age where homeowners historically begin to sell and downsize. We're looking at potentially millions of homes coming to market over the next decade, hitting right as affordability is at its worst levels in American history. This demographic shift will flood an already oversupplied market with additional inventory, just as qualified buyers continue their strike against unaffordable prices. It's the perfect storm of too much supply meeting dramatically reduced demand. As we wrap up this analysis, it's crucial to understand that what we're witnessing isn't just another housing cycle. It's the culmination of decades of policy mistakes and market distortions. For anyone thinking about buying, selling, or investing right now in early 2026, the data points us towards several clear conclusions. First, don't build your financial plan on a return to 3% mortgage money. The rate history shows that 2.8 to 3% was a pandemic anomaly, and the market expects something closer to 6% for the foreseeable future. Second, understand that affordability is still stretched in nearly every market, so any meaningful improvement is likely to come from significant price adjustments, not from magical rate relief that may never come. Third, if you're an investor, underwrite deals to cash flow at today's rates, not based on the hope of refinance to cheaper money that may not materialize. And if you're a would-be homeowner, focus less on timing the bottom and more on whether the monthly payment fits your real income in this new world where the fundamental math has permanently changed. The biggest housing market correction in American history isn't just possible based on the data we've reviewed. It's becoming mathematically inevitable. When markets reach points where the basic math doesn't work for the majority of participants, corrections aren't just likely, they're required. This is about understanding the mathematical reality of our current situation. The numbers simply don't add up anymore, and when that happens in any market, forced corrections become unavoidable. If you found this analysis valuable, make sure to like this video and subscribe for regular updates as this historic situation continues to unfold. Hit that notification bell to ensure you don't miss our upcoming market analysis as we track the most significant housing market shift in American history. Remember, understanding these market dynamics isn't just about protecting yourself. It's about being prepared for whatever opportunities might arise from this unprecedented market realignment. Until next time.